Good morning. You're watching a live daily market outlook for Monday, 20th of February 2012, prepared by Windsor Brokers. The positive sentiment in the markets remain on today's opening and during the Asian and early Europe session as markets rose on the policy easing by China and expectations that Greece will secure a second bailout a second bailout of 130 billion euros when the conversation and the negotiations with the Eurozone officials got stuck. The positive sentiment continues to keep the markets towards the upside. The risky instruments and risk appetite is fully in play as Euro and sterling heading higher and looking for test of their key highs at 158.26 on cable and 133.20 on euro. The crude oil surges higher as Iran cuts the supply of its crude oil to UK and France, hitting levels above $104 per barrel, the highest level in past 9 months. The US dollar also is in the strong uptrend in past 3 weeks from 76.00 base, hitting fresh highs and breaking actually above its key barrier at 79.52 October 2011 post-intervention high. Swiss franc extends gains versus dollar and euro as dollar Swiss heads lower after failure to clear the range. Short-term range ceiling and failure to break 93 barrier triggered fresh weakness. Also against the euro, the Swiss franc hits levels at 120.80 this morning. The gold is steady but buoyed by current positive sentiment of the markets and expectations that Greece's bailout will be approved today. However, remains within the recent short-term range and capped under the range ceiling, break of which is required to resume the broader pictures rally. Decision day for Greek bailout as Eurozone finance ministers are meeting today and are expected to approve a second bailout for Greece, a move that they hope will draw a line under months of turmoil that has shaken the currency bloc. Although there is work to be done to make the figures add up, diplomats and economists do not expect the package to resolve Greece's economic problems. They could take up a decade or more, a bleak picture increasingly apparent to several thousand Greeks who demonstrated on Sunday against seemingly endless austerity measures. The ministers still need to agree the measures to square the numbers, given the ever worsening state of the Greek economy, but they hope agreement on Monday will help restructure the country's vast debts, put it on a more stable financial footing and keep it inside the single currency zone. Senior officials from the Eurozone finance ministries and European Central Bank had a conference call on Sunday to go over the final details of the 130 billion euro program, including debt sustainability analysis critical to the IMF. While there is still skepticism in Germany and other countries that Greece will be able to live up its commitments, including implementing 3.3 billion euros of spending cuts and tax increases, officials say momentum was building for approval of the deal. So this is one of the key events today. The next, China acted, it cuts its required reserve ratio of banks by 50 basis points. The China Central Bank cut the amount of cash banks must hold in reserve on Saturday, boosting lending capacity by an estimated 350 to 400 billion yuan, equivalent to 55.6 to 63.5 billion US dollars, in a bid to crank up credit creation as the world's second biggest economy faces a fifth successive quarter of slowing growth. The People Bank of China is on the course of gentle policy easing, the cushion of the world's fastest growing major economy against the stiff global headwinds as Europe's debt crisis grinds on. although it has been trading warily. The cut announced late evening is set to boost the confidence of domestic stock investors who have been eagerly awaiting clear signs of an easing of monetary policy. The PBOC cut big banks' reserve requirements ratio by 50 basis points to 20.5% effective from next Friday, after repeatedly defying markets' expectations for such a move after it first cut the ratio last November. The Japanese trade deficit released during the night shows the deficit hitting a record high at 1.475 trillion Japanese yen. Japan logged a record trade deficit with China in January as exports dropped by a fifth, underscoring concerns about how sharply China is slowing and its ability to buffer a frail global economy against European turmoil. The 20.1% annual slump in exports to China, Japan's main export market, condemned Tokyo to a record monthly trade deficit, stark evidence of the pain from a firm yen. The global slowdown and fuel imports to make up for idled nuclear plants. Japan's shortfall with China was 587.9 billion yen, equivalent to 7.4 billion US dollars, 40% of the total trade deficit for January, Japanese finance ministry showed. While a drop in exports was exacerbated by an early Lunar New Year holiday hitting shipments of steel and other manufacturing inputs, it was still the fourth straight month of the Japanese exports to China have fallen in annual terms. Iran has said stops oil exports to UK, France, and this was one of the main reasons for the recent rally of the crude oil prices. Let's take a look now on the technical outlook for today, as today's calendar is literally empty, no events for the Monday. As usually, Monday is a quiet day. We're starting with Euro. As we can see from last week, 16th of February low, 129.73. The single currency is in steady up move with today's gap higher opening, signaling further extension higher. The high so far seen is 132.36, which marks exactly 76.4 Fibonacci retracement of the down leg from 133.20 to 129.73 low of 16th of February. The near-term studies remain positive as some corrective easing is seen currently. Mild correction that is so far contained by 131.85 20 days moving average. However, the further easing is possible towards 131.73 to keep immediate bulls in play for possible extension higher towards our key barrier, towards next barrier, the last one ahead of 133.19 at 132.82 high of 13th of February. Easing below 131.73 would risk filling the gap and a stronger correction with the levels at 131.37 and 131.15 zone again expected to contain. On the upside, break above 132.82 focuses first we have 20 days, the 90 days moving average at 132.77, and then we have the key barrier at 133.19. A positive outcome today of Greece's bailout might boost the pair higher and the break above 133.20 to open a fresh leg higher and extend the short-term uptrend from 126.22 low of 13th of January 2012. On the downside, on the wider picture, 130.43, where the 55 days moving average stands so far, is holding the downside, and it's in case of a break below here, then we would see we might risk formation of the head and shoulders pattern on the daily chart, and possible further easing, as we can see that we already have one shoulder, one head, and half of the second shoulder. So failure to clear 132.80 and subsequent weakness might risk formation However, break above 133.20 is to open 134.00 around figure resistance next. The cable is also in the steady uptrend of 156.50 zone double bottom, as better seen on the 4-hour chart after corrective easing from 59.26, where the 200 days moving average capped the upside. Found good support at this zone and formed the double bottom pattern. So far, over 76.4 of the initial rally has been retraced, with the 158.78 seen so far, just ahead of our latest barrier at 158.84, 158.81, the previous highs of 1st of February and 9th of February. We'll break here to refocus the previously mentioned key barrier at 159.26. Before this, we have 200 days moving averages shown on the daily chart, currently standing at 159.13. With break here and 159.26 to open way towards the next strong barrier at 160.00. Corrective easing is seen towards 158.00, where the strong support, along with 157.90, where the strong support lies, and it's expected to contain. This marks also approximately 38.2 Fibonacci retracement of the recent up move from 156.54 up to 158.78. Dollar yen heads north, hitting levels above and the latest key barrier 79.52 after clearing 79.00 last Friday. 79.52, 31st of October 2011 post-intervention high has been cleared. The pair reached 79.88 ahead of current corrective easing as the hourly studies hit the overbought territory. We might see some further reversal before the bulls come back in play, and the possible extension higher to test 80.00 as initial barrier ahead of 80.23. The 80.23 is the high of 31st of July 2011, and actually marks the ceiling of the range trading that started in July 2011, and the pair is now about to break above this range. That will signal a more significant recovery of the broader downtrend that lasts from 2007, above 80.23. 81.00 as around the figure comes ahead of 90 days weekly moving average at 81.16. Current corrective easing broke above overnight's low at 79.40, with the 79.20 and 79.00 seen as a strong support, where also stands 20 days moving average currently at 78.86, and it is expected this zone is expected to contain the corrective pullback. As we can see, the short-term price action, the pair didn't have any stronger pullback. It was mainly a brief correction, brief consolidation ahead of a fresh rally, and likely scenario would be like this: so shallow correction and a fresh push higher, as currently the sentiment, positive sentiment, sees scope, as the daily studies are also in the positive territory, sees scope for a further extension higher. The dollar Swiss is losing ground again, as it failed at 92.98, just ahead of 93.00 barrier, in steady decline. That was interrupted by brief consolidation at around 92 zone. Overnight gap lower opening and extension to 91.36 now sees scope for a further extension and test of key supports at 91.00 and then 90.87 base, loss of which to signal an extension of the short-term downtrend from beginning of January's high at 95.93, with the 90.75 Fibonacci level coming first ahead of round figure support at 90.00 and the 89.55, 61.8 Fibonacci retracement of the 85.66 to 95.93 ascent. On the short term, 92.00 zone offers initial resistance and is expected now to maintain to cap the upside, where is also 20 days moving average as shown on the 4-hour chart. Brief look of our today's star performer, crude oil, as it broke above Ichimoku cloud at 91.60 and cleared the previous high at 103.69 with the so far hitting 103.53, just ahead of the previous high at 103.69, high of 4th of January 2011. The steady uptrend is the steady uptrend of 95.83 and 95.43 from the beginning of February sees potential for further extension higher, as also the fundamentals are very supportive in light of Iran's action against UK and France, with some more countries of Eurozone to be involved in their cut of supply. Might shoot the oil price higher. A clearance of 103.72, her previous high of 103.69 previous highs to open the next significant level at 104.56 high of May of 2011, with possible extension towards high of big 1st of May 2011, 114.80 seen on a break. It's important that the price action will clear this congestion at around 103.50-70 zone to resume the medium-term uptrend from October 2011 of 74.94. A failure to break here might see the further ranging within the wider range of 95 to 103. Good luck.